Myself, R. Shilpa, Assistant Professor, Department of BCom BE, PPG College of Arts and Science. Today we are going to discuss the verification of assets and liabilities, one of the most important responsibility of an auditor. Verification ensures that the asset and the liability shown in the financial statement actually exist, belongs to the business and recorded at the correct value. Along with the verification, auditor also performs the valuation to ensure that the assets and liabilities are neither overvalued or undervalued. This helps to present a true and the fair view of the financial position of a business. Verification of assets and liability. Meaning of verification. Verification is the process by which the auditor confirms the existence, ownership, and the correctness of the asset and the liability shown in the financial statement. The main objective of the verification of assets are to confirm that the asset actually exists, to verify that the business legally own the assets, to ensure that the liability are complete and the correctly recorded, to detect the frauds and the error, to ensure the proper disclosure in the financial statement. Valuation of assets and liability. Meaning of valuation. Valuation means determining the correct monetary value of the assets and liability on the balance sheet. The objective of valuation are to present the true financial position of the business, to ensure the assets are neither overvalued nor undervalued, to follow the accounting standards and the principles, to calculate the correct profit and loss. Verification and valuation of asset. Verification. The verification of assets physically inspect the assets such as machinery and the furniture. The auditor examines the ownership document. The auditor verifies the purchase invoice. The auditor confirms the existence of asset. Valuation of asset. Different assets are valued differently. Fixed asset, cost less accumulated depreciation. Inventory, cost or the net realizable value, whichever is lower. Investment, valued accordingly to accounting standards, either at cost or the market value. Verification and valuation of liability. Liability represents the obligation of the business. The auditor checks the creditor statement. The auditor verifies the loan agreement. The auditors reviews the unpaid expenses. The auditor examines the legal obligations. Valuation of the liabilities. Liabilities are recorded at the amount payable. The auditor also ensures that the accurate expenses are included, contingent liability are properly disclosed. Auditor's position regarding the valuation and the verification. The auditors plays a very important role in ensuring the correctness of the financial statement. The auditor's responsibility includes verifying the ownership and the existence of asset, examining the supporting document, ensuring the correct valuation methods are used, confirming that all the liabilities are recorded, reporting any material misstatements, giving the independent opinion on the financial statement. Depreciation. Depreciation is the systematic reduction in the value of the fixed asset due to a wear or tear, usage, or obsolescence. Objective of depreciation to match the cost of the asset with the revenue they generate, to determine the true profit, to present the correct value of the fixed asset, to provide the funds for the future replacement. The common methods used are straight line method and the written down value method. Reserves and provision. Reserves are the amount set aside from the profit for the future need or the contingencies. Provisions are the amount set aside to meet the known liability or expected losses. Types of reserves: general reserve, capital reserve, and the revenue reserves. Examples for the provisions: provision for bad debts, provision for taxation, provision for depreciation. Differences. The reserve is created voluntarily from the profit, whereas a provision is created to meet the unexpected obligations. Secret reserves. Secret reserves is a reserve that is not separately disclosed in the financial statement. It is created by undervaluing the asset and overstating the liabilities. Advantage. It strengthens the financial position during the difficulty period. It helps to meet the foreseen losses commonly used by the bank and the financial institution. Limitation. It reduces the transparency, may mislead the shareholders and the investors. It does not fully disclose the true financial position. Conclusion. To conclude, verification ensures that the assets and the liability exist and belong to the business, while the valuation ensures that they are recorded at the correct value. We also learned about the auditor's responsibility, depreciation, reserves, provision, and the secret reserves. These concepts are essential for preparing the reliable financial statement and enabling the auditor to express an independent opinion on the financial position of a business. Thank you.